Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good weekend, all. Ira Epstein of Lynn & Associates with your agriculture update for this weekend of Friday, Cinco de Mayo, May 5th, 2017. And what we do on the agriculture update on Fridays, in fact, I do it in all my videos, is instead of looking at the daily charts, we focus in on the bigger picture of the weekly charts and what a week it has been. We have seen a week where the storms last week drove wheat prices dramatically higher, and now the question is how much damage was actually done. The markets have settled back a bit. We saw the cattle market soaring limits during the week, and all of a sudden today, limit down. They were limit ups. Now we're getting the limit downs, and that's so typical when markets get ahead of themselves and everybody rushes for the door at the same time. But let's go to the soybean market because that's going to be the interesting market of the week. This is a monthly chart, by the way, not a weekly chart. And it gives you an idea of the much bigger picture as to what beans are doing. And I don't think you'd have an easy time arguing with me that there's a clear-cut downtrend line and there's a support line in the market. And that's pretty much what the market's doing right now. It's caught in this, and the ranges have been narrowing and narrowing and narrowing. And this low 9 area is the area the market's trying to find the support. When you go to an area chart of closes only on a weekly basis, the market has shifted gears from this big decline. And we were up in the 1080 areas, or for a closing basis, let's call it 1060s, fell apart to 942, and the market is giving us a bit of a bounce. Okay. The question is this a spring low? Is the market ahead of itself? Or did this big break happen? And I think what happened with the big break is the profitability of planting beans, if you look back to the beginning of the year, was really solid. And I think farmers and the markets realized that, and prices started coming down in the beans as the ideas were there. We're going to plant more and more beans. It's the crop to plant if you wanted to make some profit, because corn prices weren't anything near this. You can see that on the weekly chart, on a bar chart, you're in an up thrust. You've carried from 929 3/4 up to this week's high of 973.5. So we've had roughly a 44-cent rally in the market that has carried prices up a bit. It's not stellar, but it is the bounce. When we take a look at the swing line study, you have a classic pattern of bearishness. Lower highs, lower lows. Sorry, that's what the pattern is until you take out, under the current chart pattern, 1008 3/4. Should the market get under this week's lows of 950, it could put the market in pattern to challenge the current low of 929 3/4. The first resistance point, as I see it, is the 100-week moving average of closes. Now, in the past, the patterns have been that when you get under that number, you stay under it for a while, and then you try to pop back up to that 18-week moving average of closes. Should the same thing happen again, this number is going to drop this week because you're going to drop back a higher value and replace it with this lower one. But it'll be here, and last week, let's see, it was $10 3/4, 988, 998. So it dropped there just a little bit, not all that much, as you can see. I'm going to figure it's going to drop 2 to 4 cents. So it'll put it in line still underneath this area if you get a good rally up to it. And that word is if. I'm not saying that you might not be stymied at the 100-week average again, but as you saw from what I showed you, that's the zones that I'm looking at. Bollinger Band was hit, and you hit it for 3 weeks in a row, then you finally bounced away. Should the 29 3/4 give ground, a potential might be to 916 1/4. Who's controlling the market at this point? The bears are. Lower highs, lower lows. You're under both the 18-week moving average and the 100-week moving average of closes. Momentum. Momentum is still sideways under 20. Bears still have it in terms of even momentum. So yeah, bounce. If you get back over the 20 level, I could argue that maybe that's what's going to signal going back towards that 18-week moving average of closes. The meal market on the weekly chart is still bearish. The daily was friendly, and it was a phenomenal trading week in it if you got my market information. But it was lower highs, and now the question is it going to make higher lows, or is it going to slip back under 308.90? And if it does, I've got to tell you, then I'm going to be targeting the lower Bollinger Band. This market is still, on the weekly chart, not looking good, and momentum is still bearish. When you come to the soybean oil, all you did in the whole grand scheme of things is get back up to the 18-week moving average of closes. Now, I know I pointed out here, like I did in the soybeans, the first challenge of the 100-week averages you often get a bounce away from. And if you take a look here, you did it like that, and then you bounced back to that 18-week average. That seems to be what the market is doing here. It is not a trend changer. Momentum is pointing up. Can you get over 33.94, which is 123 points away, to take out the swing line high? Or does this market fail again, get under this week's low of 31.60, and resume a move towards 30.41? I don't have the answer. I'll let you answer it. In the corn market, corn is caught in this narrowness of the upper and lower Bollinger Bands. It is fighting a battle against a combination of the 100-week and 18-week moving average of closes, and it's under both. At this point, it still has the downside bias to it. It's very important for the bears to take out this week's low of 357.5 if they hope to make a run towards that lower Bollinger Band. If the markets can get up and over everything here in those 365 levels, well then potentially 375.5 is the next resistance point. But the bears are the ones fighting for control, but it's a mixed bag here. Why is it a mixed bag? You've got still the pattern of higher lows, but now you're starting to make lower highs. I want you to look at this week's high, 370.5 versus this high of 373. I keep it with the pattern that the swing line's up for a reason. You had set back here higher lows and higher highs, and you haven't broken that pattern. So the legacy of that pattern is still in place. But, and there's a big but here, for the bulls, they've got to prove themselves, and they're the ones, I think, more or less fighting it. If you were to be not looking at that, you'd say the swing line's up, but because prices are under the 18-week moving average of closes, the two counter each other. And then momentum is still flat, as best I can tell you. In the wheat, you know, sometimes you got to look at the chart, not read the newspapers or your, in today's world, the computer screens, right? Because so much information's flying. When the wheat market got up this week, you can see last week, this is how you finished. The market was at 418.5. First resistance, if you rally, 426.5. And if you get up to the upper Bollinger Band, that's 446.75. We had a winter storm coming in. I don't think anybody thought there was going to be 20 inches of snow hitting parts of Kansas. So the market gets all the way up to 445.75 Bollinger Band. The price action hit 450.75. By the end of the week, you've given back 20 some odd cents. So I will stick with what I teach. The first challenges of Bollinger Bands are where I think pros unload positions. That's it. I'll say it here, I'll say it here. Yeah, it went higher, and then it went to the 100-day average and slipped back. It's a rule of thumb that I truly believe in, and it's what I teach in my charting course, which you can all take advantage of, by the way, by going to www.iraepstein.com. Under the word education, it's right there for you. Take a look. I think you'll find all the facts are there, short videos on it. Pretty cool stuff. In cocoa, the big question now, do you have the power to take out 1883? If the market does, it could set up a pattern where for the first time you no longer have the, in a while, the lower highs, lower lows. It'd be reason to no longer be short this market. Could the momentum kick it up to 2024? Well, if the momentum turns up, it hasn't yet. But I'm just pointing that out. You're about 20 points, 17 points away from that number. Got to be a bit cautious there. Sugar still looking sick as can be. It still has the lower highs, lower lows. Yes, it's under the 100-week average, but it's not shown any sign of life coming into it. So 1488 is still a target. Momentum is still pointing down. The bears have grabbed control of that market. Coffee has had failures now for the past part of, in fact, for most of 2017 against the 18-week moving average of closes. When it's hit the 100-week average, it has gotten a bounce. This is no different. It slid through it last week, but it's back to it right now. Let's see which way it goes this week. In the cotton market, you are fighting a big-time battle at the upper Bollinger Band, where the market often runs into momentum shifts, and you might get that right here if you start coming back down. Could be back to the 18-week moving average, but there's no sell signal. Let me explain this. You have a pattern of a higher high and a lower low. There's no trend. Bias is still up because you're over the 18-week average. Momentum has turned flat on you. In the cattle market, I don't even know what to say. This is a market that soared last week, and for the weekly chart, you wouldn't believe cattle was limit up this week. It was several days, and all of a sudden it started falling apart. Battleground 100-day average of closes. Momentum has shifted to the downside. Do not lose sight of that. If prices fall further, if this number, the 100-week, doesn't hold, which was when you got over it, now it's support, then the 18-week average is the support. The trend, what is it? Up. You have higher lows, higher highs, markets in a corrective mode. It paid attention to the upper Bollinger Band. Momentum's pointing down, but the trend is not down. It is up. Momentum is pointing down. In the hog market, you have gotten over now the 100-week and the 18-week moving average of closes. The pattern is ugly in that you got a higher high and a lower low. Momentum has shifted to the upside. More or less, I think you could be caught in the Bollinger Bands if you can get more of a rally here. But you haven't been able to get to the upper Bollinger Band since the whole year began. Why would it change now? So be a bit cautious if you're long here. Should the market get under these two numbers, you're going to get into a bearish bias very quickly. All it will take is breaking 66.02, which admittedly is 300 points away. That's not an easy move to get done. But if you did that, you'd say, I got lower highs, I've already got lower lows, and I'm back under the 100 and the 18-week moving average. Let's assume you're bullish, okay? You've still got to come up here and take out 71.26.5 to make the market have the higher high. From where you're at, that's about 200 points away, so I'll be watching to see what that does. Now, one of the things that I want you to do, I know I have a big following out there, is take advantage of the free access if you haven't tried it to my market research. Why? Because you're going to start off your day like I do. At 8:30 in the morning, I truly have coffee on my desk, I put on my headset, and I review 40 charts, and I throw out so many ideas at you for day trade, position trading, that your mind is going to spin a bit. And I'm using the indicators I have. I'm not in the video like I am here. I've got my headset on, I'm copying what I'm seeing on my computer and throwing out all these ideas. I certainly back it up because at nighttime I write a report, in the morning I write a report, and then during the day if I see specialties that come up, they're called special updates, and they come flying at you. It's all part and parcel of what I call my market research, and part of that is if you want the Lynn Group research, we include that too. You get it by giving us a call at this number. You can go to our website. You'll see the free offer there. You could just as well click up here if you're watching me on YouTube, or on many websites. Underneath us, it says, click here for Ira's research. If you see that, open up the form, and it'll work that way. Unfortunately, if you've tried my research, it's time for you to take a purchase. You're not committing to anything but 30 days at a time. You can stop it whenever you want. As I broke it down today, because I have people that have tried it, and I'm trying to show them, it's basically, if you don't trade through us, a penny in grains a month. It's less than $0.50 it's about $0.50 in the gold market. It's a tick or two in bonds. I mean, come on, tick and a half. it's well worth, I think, you're putting this on your must-do list to give it a try. You don't have to. It's up to you. I'm Ira Epstein. You have a great weekend. I'll see you all Monday.